Welcome everyone to Center for the Women of New York presents Financial Literacy Series, Tax Workshop Part 2. Credits and Deductions Overview, Dollars in Your Pocket. Hosted by Victoria Pilati and Cecilia Venosta Weigel. And our guest speaker is Kathleen Carroll. Since our founding in October of 1987, the Center has shown that women working together can be an effective force. We are a voluntary nonprofit organization dependent on dues from our members and on the voluntary efforts of business, professional, and community women and men in New York City. At the Center, we believe education is the cornerstone of women's economic independence. We advocate strongly for women's full equality by partnering with like-minded organizations and elected officials. Whether we're marching for worthy causes, celebrating women's accomplishments in leadership, the arts, or sports, camaraderie is a hallmark of CWNY. We've come a long way since the second wave of the women's movement in the latter half of the 20th century, and while there are many struggles ahead, we celebrate how far we've come.
Good evening, everyone. I'm Cecilia Venosta Weigel. I'm Vice President of the Center for the Women of New York. And I wanted to share with you our current services and if you would like to take advantage of them. We do have a caregivers phone support group, a conversational English second language class, a legal support team that's available via email for any inquiries you have. We have referral services, so if you're not sure if we offer anything that you need, just reach out, we'll refer you, we'll guide you, where you need to go. We offer webinars on women's issues. We have individual counseling for women in crisis, as well as support group for women in crisis. Upcoming is our book club. We recently found a couple of volunteers to run that, so we're excited to bring it back to you. We offer career workshops, computer classes are also coming up. Financial literacy series, which is what you have right now. Green team, very excited for when we open our Fort Hudson location, we'll have some activities with the green team there. We're also planning a women artists exhibit, and we're bringing back our walking group for whenever COVID allows us. Our next workshop, I'm sorry about that. Part 3 is New York State. Let's see, my screen is not cooperating. New York State personal income taxes, and that will take place on Wednesday, March 17th. From 8 p.m. To 9 p.m. with Kathy Carroll. Also, if you would like to donate, you can find our, like a place to donate on our website, cwny.org. You can also become a member or volunteer. You can find all this information on our website. If you'd like to download the PowerPoint that Kathy will present today, you can also find it on past events on that section of our website. And we would love to know where you're coming from, and that will help us know our audience, what you need, and will also help us with funding. So if you could please fill out the very short form that our volunteer will put in the chat. It's just your name and your zip code. That will be a great help for CWNY. If you dialed in, please email your zip code to events@cwny.org. And that's also for your questions and answers. If you dialed in, you can email again is events@cwny.org. And if you have any questions, they will be addressed right after the presentation. You can use the chat box at the bottom of your Zoom screen, and you can type them anytime. You don't have to wait until the end. Kathy will respond at the end. And welcome, everyone.
And so now let's learn a little bit about our guest speaker. Kathy is a professional accountant, an enrolled agent to practice before the Internal Revenue Service. She has been practicing accounting and providing bookkeeping services since 1981, and she works with individual and corporate clients. She directed and ran the Student Association Income Tax Preparation Program at Queens College for 26 years. She also ran an annual seminar at the International Students and Scholars Office at Queens College. These programs provided free on-campus tax prep and advice to students. She received a Bachelor's in Science in Accounting from the C.W. Post Center of Long Island University and attended I don't know how this came up. But anyway, this is what is in your chat box. All we need is your name and your zip code for our funding purposes. And so Kathy attended a graduate program at New York University. Welcome, Kathy. We look forward to your presentation.
Thank you, Victoria. Thank you, Cecilia. And thank you, Lana. Okay, hello, everyone, and good evening. Welcome and thank you for joining the webinar. This is Tax Trauma Terminated, 2020 Tax Filing Tips Part 2, Credits and Deductions Overview, which will put more dollars in your pocket, we hope. So now, if we can have the next slide. As of last Friday, February 12th, 2021, the tax season for the filing of 2020 tax returns finally opened. It had been delayed this year for several weeks because of the issuance of the stimulus in late December of 2020. The IRS had to redo the tax forms to allow for people who did not receive the checks, either direct deposit in their bank accounts or in the mail. So consequently, people could prepare their returns and e-file them, but until last Friday, they were not being processed. So now they are being processed. And for those taxpayers who did not receive either the stimulus of $600 recently sent, or even the previous stimulus payments that were issued in mid-2020, the recovery rebate credit, which is on your 2020 tax return, will enable you to obtain it. So no one will be missing out on either one of the stimuluses that were issued during the year 2020. What are credits and deductions? In the first part of this series, we were introduced to the most common types of income and the documents that people typically receive to report that income. W-2s, 1099 non-employee compensation, which was for self-employment and independent contractors, and 1099-G, unemployment compensation, which many, many people are going to be having this year. I just want to remind people again that the 1099-G will not be received in the mail, that if you did receive unemployment during 2020, you'll have to look for this document on the New York State Department of Labor website, and you need to print it out. If you're preparing your own return, you need the information from it, or else if you're using an accountant or a tax preparer, you need to bring that to them. In the second part of this series, we will review the available credits and deductions available to put more money in your pocket at tax time. The terms credits and deductions are both money savers for the taxpayer. Many taxpayers can benefit from either one or the other, and sometimes both. A credit will directly reduce your tax on a dollar-for-dollar basis. Some credits, such as the Earned Income Credit, which is commonly called the EITC, and certain education credits, will even refund you the amount by which the credit exceeds your tax liability. So generally the purpose of a credit is to reduce your tax liability as much as possible or even to zero. But these two credits will actually send you back the difference if the credit exceeds the tax liability. A deduction is an allowable item that will reduce your taxable income so that your tax liability will be lower. Deductions do not reduce tax liability on a dollar-for-dollar basis. The benefit is based on the individual's tax rate. Deductions are an allowable amount that reduce one's income in arriving at taxable income. All taxpayers may choose to use the basic standard deduction to calculate their taxable income. Most taxpayers will have to use the standard deduction if their potential itemized deductions do not exceed the standard deduction threshold. The standard deduction is the basic amount allowed to reduce income. The amount of the standard deduction is based on one's filing status. The filing statuses are generally single, married filing jointly, married filing separately, and head of household. Under the TCJA, the Tax Cuts and Jobs Act, which came into effect for the 2018 tax year, the standard deduction was increased significantly. The standard deduction amounts for 2020 are single, $12,400, married filing jointly, $24,880, head of household, $18,650, and married filing separately is the same as single, it's $12,400. Now, what the standard deduction is, as we discussed in the first part of the series, that these are the amounts that theoretically, if one does not make this amount of money, theoretically, they might not have to file a tax return. But as also was discussed in part one, it's usually very important and beneficial in many ways to file a tax form, no matter, even if your income is less than these amounts. Itemized deductions are a list of specific items that, when grouped together, will lower your taxable income if they exceed the amount of your allowable standard deduction. For example, if a single person has itemized deductions in the amount of $13,000, it would be beneficial for them to use this amount rather than the allowable standard deduction of $12,400. But this process is not as straightforward as it appears, as we will see. We will see shortly. There's a few different types of itemized deductions. The new tax act that came into effect in 2018 reduced the amount of itemized deductions fairly significantly. So the current list of itemized deductions is fairly limited. So the types of itemized deductions that are currently available to taxpayers include medical expenses, which would include insurance premiums, out-of-pocket expenses, co-pays, vision expenses, eyeglasses, contact lenses, things of that nature, and dental expenses. And also travel to and from doctor's offices, such as cost of taxis, and also mileage on your own car to and from a doctor would be deductible at 9 cents per mile. However, this is where the catch is with this deduction. Your medical expenses must exceed, and I'm sorry, that's an error. It's supposed to be 7.5% of your income before you can use any of it. So in the example, I used 10%. 10% was last year's threshold for 2019. For example, if your income is $50,000, your medical expenses would have to exceed $5,000 before any of the amount becomes usable. And then only the difference between the amount and the base is counted toward the deduction. So it's not even a cumulative deduction. So if you had $6,000 worth of medical expenses, you would have to deduct the $5,000, so you would only have $1,000 that would be usable. Other types of itemized deductions include state and local taxes withheld from one's pay during the year, as well as any balance due paid on a prior year's state tax return. So if you filed your 2019 return and you owed the federal government money, there's nothing that can be done with that. That's not any kind of deduction for this year. But if you had to pay New York State, you would be able to deduct the amount you paid to New York State or any other state. You would be able to deduct that on this year's federal return as an itemized deduction. And then you would also be able to deduct real estate taxes. These two itemized deductions are referred to as SALT, state and local income taxes. You may have heard this term used quite a bit in the media because it's been quite a controversy about this in the state of New York and other high tax states. The SALT deduction is currently limited to $10,000 per taxpayer or per joint return. So it's actually per return. There's been much controversy about this limitation, particularly here in New York and several other highly taxed states, including neighboring states of New Jersey and Connecticut. In fact, the SALT limitations impact approximately 10 states or less throughout the United States, because in most areas, many states don't have state or local income taxes, and the real estate taxes are much lower. So the $10,000 threshold may not have a significant impact on, let's say, a taxpayer in Florida. But here in New York and our surrounding states, it does have quite an impact. Okay. List of itemized deductions continued would be mortgage interest. And mortgage interest includes interest paid to banks and private lenders and includes points and origination fees paid on a purchase. If you purchased a home this year, you should take a look at your closing statement because you may have paid mortgage interest and real estate taxes that may not appear on the form 1098 that your lender provides. Now, if you have a mortgage on a house, you will receive a form 1098 from your bank, and it'll tell you typically the amount of interest that you've paid during the year. It'll tell you the remaining mortgage on your mortgage balance on your loan. And most of the time it tells you your real estate taxes also. But at a purchase, some of this information is not going to be on that 1098. So you have to refer to your closing statement so that you can get the most benefit from this deduction. Mortgage interest in general is not limited. There are circumstances where it is limited, but that refers to mortgage interest on more than 2 homes, vacation homes. So for the most part, the typical taxpayer will be able to take all the mortgage interest that they've paid during the year. Charitable contributions. Charitable contributions can be deducted for both cash and non-cash items. If a cash contribution of more than $250 is made to a single recipient, such as a church or a charitable organization, a receipt is required to be kept in your records, just in case, the IRS should ask or any authority should ask. You don't have to send in the receipt with your tax return. You just have to have it in your file. Non-cash contributions such as clothing and household items must have a receipt for contribution amounts over $500. Many people believe that in the case of a non-cash contribution, the organization will let you know the amount of the deduction. And this is not the case. All the organization will do is give you a receipt for what you donated. They'll probably itemize it, or they'll say, in the case of maybe if you bought bags of clothes, they might say the number of bags, things like that. But they are not the ones that determine the amount. So it's up to the taxpayer to figure out what they think the donation is worth and just have the receipt that they gave such a donation during the tax year. Now for 2020, there is something new for the charitable contributions. Generally in the past, you could only deduct your charitable contributions of any kind if you itemized. For this year, even people taking the standard deduction are allowed to have a $300 charitable contribution deduction in addition to the standard deduction. So even if you're not able to itemize, You can use up to $300 of charitable contributions to reduce your taxable income. Okay, now I want to say something about miscellaneous job expenses, because this, in my experience of doing taxes, this has always been a very, very popular deduction, but it was usually less helpful to people than they thought because it had a limitation on it. But in any event, up until 2018, people were able to deduct to a certain degree miscellaneous job expenses such as union dues, work clothes, work tools, work travel, job-related education, and other items of this type. These have been eliminated as deductions. So in the past, people used to spend a lot of time putting this together, adding it up, and then bringing it into when they were having their taxes prepared. There's no longer any need to do this because this deduction is gone. With the only exception to that is teachers are allowed a $250 adjustment to income, which is a separate category. It's not an itemized deduction, so everyone can take it if they're a teacher, whether they itemize or take the standard deduction. So teachers are allowed a $250 adjustment to income for their purchase of school and classroom supplies. Now this year with the COVID-19 pandemic going on, they have included as classroom supplies things such as masks, disinfectants, safety supplies for the classroom, and COVID-19 related protection items. But I had a question already from a teacher that she thought this was something different than the $250 amount. Because I think it had been publicized maybe somewhat inaccurately. This amount for teachers is not in addition to the $250 that already exists. It just expanded the amount of items that are included. So in the past, if a teacher spent money for like books or pencils or artwork for the classroom, that was included in this $250. Now the other items are also included, but it's not in addition to the $250. It's to be included with it. So the deduction itself did not change. Okay, the bottom line on the itemized deduction is this. Due to the limitations placed on them, limits on medical expenses, 7.5% of your income, SALT cap, $10,000 maximum deduction, most taxpayers will not be able to itemize and will use the standard deduction. Itemized deductions can be most frequently used by taxpayers who own homes and have significant mortgage interest to deduct, since there is no limitation on that. Now we want to look at credits. Unlike a deduction, a tax credit can save a taxpayer money on a dollar-for-dollar basis. In some cases, if your tax is reduced to zero by a credit, you may be able to receive the additional amount of the credit. This is known as a refundable tax credit because the additional money is refunded to you. So it's not lost. A quick overview shows that there are at least 20 credits, there's actually more, non-refundable and refundable, available to the average taxpayer. These include the earned income credit, the child tax credit, additional child tax credit, and education credits, the American Opportunity and Lifetime Learning credits. These credits help families raise and educate their children. The most popular credit that's out there is the earned income credit. The earned income credit is a refundable credit based on income and family size. Although mostly designed to help families, this credit is available to single persons and married couples with no children up to a certain income limitation, which is pretty low. I think it's $21,750 if you have no children. There is an age requirement. Taxpayers must be between the ages of 25 and 65 to be eligible for the earned income credit. So people over 65 and people under 25, even if they qualify in every other way, they will not be able to get the earned income credit. In all cases, the earned income credit is determined based on a sliding scale, which is based on the relationship between your adjusted gross income and your earned income. Earned income is defined as money received from a job, such as a W-2 form, or net income from self-employment. That would be a 1099 NEC, which you would be filing a Schedule C. Interestingly, if you have self-employment from a partnership or an S corporation, which you receive a Schedule K1, that type of income is not considered earned income, even though it most certainly is in every person's case. But for tax purposes, for the earned income credit, that income does not count. In addition to age and income, the EIC is based on family size. The maximum amount of the credit for 2020 is, if you have one qualifying child, you would receive an additional $3,584. For two qualifying children, you would have $5,920. And for three qualifying children, you would have $6,660. Now, what the IRS is saying is when they say qualifying children, sometimes the children don't actually have to be your biological children. They would have to be children, maybe, a niece or a nephew or someone that's living in your home that you're providing more than half of their support. For example, if your income falls into the highest range of the sliding scale and you have 3 children, you could receive a full refund of your taxes withheld, plus an additional $6,660 from the IRS. So this actually is a great, it's really a great help to people that may be struggling, maybe they're not making too much money to support their families. Now, this is something new for this year. I have yet to come across this in the taxes that I've been working on, but regarding unemployment compensation received in 2020, unemployment compensation is fully taxable income. However, it is not considered earned income. In many cases, the calculation for the EIC is going to be thrown off by the addition of unemployment, unearned income on the tax return, possibly reducing the amount of the earned income credit for the taxpayer. Because as I discussed in a previous slide, the calculation is based on a relationship between all the income you receive and the part that's actually wages or self-employment income. So if someone has received quite a bit of unemployment and not so much in wages because they were laid off because of the pandemic, it's going to throw the whole calculation off. And a person that maybe in the past would have gotten these larger amounts up to over $6,000, they may wind up getting quite a bit less just because of the way the calculation is structured. So I think we're going to have to see if the IRS is going to do anything about that, which I'm sure they probably are not. So that's something that we have to look out for with this. So the next one would be the child tax credit. For the years 2018 through 2025, the child tax credit is set at $2,000 per child for each child under the age of 17 at the end of the year. If a child turns 17 on December 31st, he or she will not be eligible for the credit. Actually, their parents won't be eligible for the credit. So you actually have to be 17 or under the whole entire year, not even one day that you turned 17 itself. The credit is available for taxpayers whose modified adjusted gross income is less than $200,000, $400,000 if married filing jointly. So for most of the people that I'm working with, and I think most of the people in this webinar, I think that they would be able to qualify for the child tax credit. All children must have a valid Social Security number by the due date of the return. So that means that obviously if you want to have a child be eligible for this credit and they're just newborn, they would have to have their social security number in hand by April 15th of 2021. And that may seem like kind of like, well, you would think of course they would have it. But as I was discussing in part one of this series, last year, even before the pandemic, there seemed to be some kind of a problem with the newborn children getting these social security numbers right away. And I had a couple of clients last year that had to wait to file their returns because they didn't have their children's social security number yet. The child tax credit is generally limited to your tax liability. However, if your earned income is $2,500 or more, which that's a very low limit, or if you have 3 children or more, the excess amount may be refunded to you as the additional child tax credit. So this is another credit where you would actually get money back, even if your tax liability is reduced to 0. Then another very popular credit is the education credit. Everyone knows the high cost of going to college these days. While talk of student loan debt relief and other ways to relieve college costs are being discussed, one thing that has been available to parents, and in some cases the students themselves, are the education credits, the American Opportunity and the Lifetime Learning Credit. The American Opportunity Credit is available for the first 4 years of higher education at an accredited institution. So that means you have to go to, a regular college or a regular trade school. It has to be accredited by the state in which it's located. The Lifetime Learning Credit is available for education for any years thereafter, the first 4 years. Excuse me. The American Opportunity Credit is 40% refundable in most cases. Now, with the education credits, the only, what I was saying about that in some cases, the students themselves can get it. The student themselves can get these credits if they're over 24 years old. If they're under 24 years old, the credit goes to their parent. So that's one of the restrictions on that credit as far as the student themselves getting it. They have to be not a dependent of their parent and over 24 years old. So the 3 major tax credits discussed tonight would be the most likely to apply to the average taxpayer. That's why I wanted to discuss them a little bit in depth, and also because of the fact they're refundable. There are many more credits that are available that can help taxpayers reduce their tax liability. Information on these credits can be found at www.irs.gov. Thank you for your attendance. Our next topic in our series will be an overview of New York State personal income taxes. And you would be surprised that even if you're filing a federal and a state return at the same time, what can be included or not included can vary greatly from the federal to the state. Thank you very much.
Thank you so much, Kathy.
You're welcome.
Sorry, I couldn't unmute myself. Again, like the first portion of this series, the first workshop was great information. This one was also great. Thank you so much.
You're welcome.
We really appreciate you doing this for our audience. For everyone here, we'll go to the question and answer session. Please put your questions in the chat. I haven't checked to see if we have any questions. If you have dialed in, please write your questions in an email to events@cwny.org.
And while we're waiting for questions, we have resources on this PowerPoint, which will be on our website in the next few days, but they are quickly here. Kathy referred to the irs.gov website. It is very user-friendly. It has great forms on it. It is well organized. Please do visit irs.gov. And in her last workshop, she referred to efile.com, which had a list of free tax services and low-cost tax services. And then there are other organizations. American Savings Education Council is a great resource. Financial Literacy and Education Commission, Pension and Welfare Benefits Administration, Social Security Administration, and of course, Women's Institute for Financial Education and Women's Institute for Secure Retirement are wonderful resources for women. And don't forget AARP. Their magazine is wonderful if you're a member, and their website is fantastic. And they have great resources for avoiding identity theft and any kind of financial issues. So please do visit these resources. They're all free.
Thank you, Victoria. So there is a question in the chat. It says, are you saying that that what were normal deductions for employment, such as books, journals, shoes, are no longer deductible under job deductions?
That they are not deductible if you are an employee, if you receive a W-2 form. If you're self-employed, they're absolutely deductible. But as far as anyone that works for a company, like let's say someone is a construction worker and they work for a union, they get a W-2 form, their union dues, work clothes, tools, all that stuff, no longer deductible. But if you're self-employed, yes, those are all deductible. So it's a difference in the, again, the type of document you receive and the type of employment that you have. But in general, for most people that have just a regular job, no, none of that is deductible anymore.
Thank you, Kathy. And there's a follow-up question. Does that include additional sessions like conferences? And I guess this is for both, if you're an employee or self-employed.
Yeah, it will be the same thing. If you're an employee, none of it is deductible. If you're not an employee, if you're going to conferences on your own, like in my business, I can deduct all my conferences, all my continuing education, things of that nature. But if I was working for someone as an accountant, I would not be able to do that. Whereas in the past I could have, to a certain degree.
Thank you, Kathy. Those are all the questions that we have in the chat. And please feel free to, we still have a few more minutes. So if you do have questions, feel free to write them in the chat. So Kathy, I have a question. Like you did say like that if you had, you know, the 3 children, and I don't have 3, like, but I have many friends who have 4 children. So is it 3 the maximum, or it will?
No, because the additional tax credit, it rolls over to additional children as well. So okay. Basically, the more children that are involved, the more money that the credit is. It's just that it's refundable over 3. Under 3, it's just like it would wipe out your tax liability, and that would be it. But over 3, you get the extra money back. You get it back in your refund. Okay. So it actually puts money into your pocket.
Mm-hmm. Thank you. Well, thank you everyone for joining us. And let's close the chat here. Again, you can follow us on Facebook, Instagram, Twitter, and we also have a YouTube channel where you will find this video of Kathy, other workshops in this series, and many others that we offer. If you would like to reach out to us, you can always reach out via email or over the phone. If we are not there, please leave us a message. Our email address is events@cwny.org, and our phone numbers are 718-793-0672. And the other phone number is 718-229-0020. All right, and that's we've reached the end of this presentation, but as mentioned, we have another one. Remind me the date. It's the third.
March 17th.
That's right. And that's the third Wednesday of every month. We'll have workshops like this that will educate us on finances. Thank you so much, Kathy. Again, it was a great presentation, and on behalf of our audience, thank you so much.
It was very educational. Thank you, Kathy.
My pleasure. I'm happy to be able to do the presentation.
And for all of you who are listening, who are watching, and are here, please feel free to spread the word. I'm sure there's so many people that could benefit from this. Have a good evening, everyone.
Good evening.
Thank you so much for coming.